Imagine you wake up on June 9th, 2024, check your phone, and financial media is on fire. Headlines scream, Saudi Arabia ends 50-year petrodollar agreement. Gold surges. Bitcoin rallies. Doomsday economists declare the dollar dead. Search interest for petrodollar hits all-time highs. Investors panic. Your retirement account feels suddenly fragile. The entire global economy, you're told, just lost its foundation. The deal that forced the world to buy dollars for oil, the agreement that gave America unlimited credit cards for half a century, the treaty that made the greenback the king of currencies, it just expired. 50 years. Gone. Except, here's the problem. While Washington scrambled, while Treasury officials frantically checked the archives, while millions of Americans watched their feeds in horror, they discovered something bizarre. The agreement everyone was panicking about, the treaty that supposedly forced Saudi Arabia to sell oil only in dollars, the diplomatic masterstroke that saved American economic hegemony in 1974, it never existed. Not as a treaty, not as a contract, not in any legally binding form. So if the agreement was fake, why is Saudi Arabia actually pivoting away from America? What changed? And what does that mean for your dollars? The story everyone believed went like this. In 1974, after the Arab oil embargo sent gas prices through the roof, and Americans waited in mile-long lines to fill their tanks, Secretary of State Henry Kissinger flew to Riyadh and cut a deal. Saudi Arabia would sell oil exclusively in US dollars. In exchange, America would provide military protection and weapons. The agreement locked the world into needing dollars for energy, creating permanent global demand for American currency, and gave the United States the ability to print money without consequence because every nation needed dollars just to keep the lights on. It was the financial architecture of American hegemony. Elegant, simple, bulletproof. Here's what actually happened. The official 1974 agreement, the one you can actually read in the archives, was called the United States-Saudi Arabian Joint Commission on Economic Cooperation. It was about infrastructure development, building roads, modernizing ports, technical assistance. There is no clause, no provision, no sentence requiring oil sales in dollars. Saudi Arabia continued accepting British pounds for oil after 1974. The dollar dominance everyone attributed to diplomatic genius was actually just economic inertia. The dollar was already the world's primary reserve currency from Bretton Woods. Oil exporters used dollars because everyone else used dollars. It was convenient, not compulsory. But there was a secret deal, one that remained classified until 2016, when Bloomberg finally dragged it into the light through Freedom of Information requests. The United States promised Saudi Arabia military aid, weapons, and security guarantees. In exchange, Saudi Arabia would recycle its oil revenues, those massive petrodollar surpluses, into US Treasury securities. The money would flow back to Washington to finance American deficits. It wasn't about forcing dollar-denominated sales, it was about what happened to the dollars after the sale, and for 3 decades, it worked beautifully. Saudi Arabia ran current account surpluses of 50% of GDP in the 1970s. That ocean of cash flowed into treasuries, quietly financing America's Cold War spending, its trade deficits, its imperial ambitions. But here's what the panicked headlines in June 2024 completely missed while everyone obsessed over a treaty that never existed. The actual collapse had already happened, slowly and quietly, while no one was watching the numbers. US imports from Saudi Arabia didn't decline, they collapsed. 1.4 million barrels per day in the year 2000. Just 336,000 barrels per day in 2024. That's a 76% drop. America didn't need Saudi oil anymore because America was pumping 13.2 million barrels daily from its own shale fields, making it the world's largest producer. Meanwhile, China was consuming 21.7% of Saudi Arabia's total exports. The customer had become the competitor. The protector had become irrelevant, and Saudi Arabia's fabled surpluses, they collapsed from 50% of GDP to 0.5% by 2024, heading toward deficits by 2025. The kingdom needs oil at $96 per barrel just to balance its budget. Reality is $70. Vision 2030, that ambitious plan to diversify away from oil, cost hundreds of billions. The wells still pump, the reserves still sit in the ground. But the financial model is dying. The agreement everyone feared losing had already been dead for years, killed not by diplomatic theatre or treaty expirations, but by American shale wells and Saudi Arabia's desperate economic mathematics. The real story isn't a document expiring, it's an empire quietly shopping for exits while pretending the old rules still apply. So what killed the arrangement that everyone thought was unkillable? The answer is beneath your feet if you live in Texas, North Dakota, or Oklahoma. It's trapped in rock formations that geologists knew about for decades, but couldn't access economically. The shale revolution didn't announce itself with treaties or summits. It announced itself with drill rigs and fracking fluid and horizontal wells that unlocked 100 billion barrels of oil that conventional wisdom said would stay in the ground forever. The 1974 understanding worked because of one brutal, simple fact. America needed Saudi oil. The dependence was absolute. When OPEC cut production, Americans waited in gas lines. When prices spiked, the economy seized. The vulnerability was strategic, economic, and existential. Saudi Arabia held the leverage because they controlled something America couldn't live without. That was the entire foundation. Remove that dependency, and the whole structure collapses. Here's what happened. In 2008, the United States produced 5 million barrels of oil per day. By 2024, that number hit 13.2 million barrels per day. That's not an increase. That's a transformation. The largest and fastest oil production surge by any nation in history. The Permian Basin alone, that stretch of West Texas and New Mexico that used to be written off as tapped out, now pumps 6.3 million barrels daily. That's nearly double the total volume Saudi Arabia exports to the United States. Except Saudi Arabia doesn't export that volume to America anymore because America doesn't need it. The numbers are stark. 2000, America imported 1.4 million barrels per day from Saudi Arabia. 2024, 336,000 barrels per day. The United States cut its Saudi dependence by 3/4, while becoming not just self-sufficient but a net energy exporter. The customer became the competitor. And here's the detail that matters. American shale isn't just abundant, it's responsive. Conventional oil projects take years to bring online. Shale wells produce in weeks. OPEC cuts production to boost prices. American frackers respond in real time, capping the rally and capturing market share. The monopoly on swing production, that crown jewel of Saudi leverage, shattered. And the costs? Permian Basin breakeven sits at $62 to $64 per barrel. That's competitive with Saudi Arabia's fiscal breakeven of $96 per barrel. Let that sink in. The Saudis can pull oil from the ground for $3 to $5 per barrel, the lowest lifting costs on earth, but their government needs $96 oil to pay for the subsidies, the mega projects, the legitimacy purchases that keep the kingdom stable. American shale producers, operating in a free market without welfare states to fund, can turn a profit at prices that leave Saudi Arabia bleeding deficits. In 2024, US crude production grew by 270,000 barrels per day, despite running 26 fewer rigs than the year before. Technology improvements, efficiency gains, artificial intelligence optimization. The revolution isn't stopping, it's accelerating. Saudi Arabia watched its largest customer become its largest competitor, while sitting on reserves that increasingly look like stranded assets, in a world transitioning away from fossil fuels. When your buyer stops buying and starts selling against you, when your security guarantor stops needing what you're selling, the calculation changes. The economics demanded diversification. China was waiting with open checkbooks and zero lectures about human rights. While Western media obsessed over mythical treaty expirations and debated whether a document that never existed had finally expired, Saudi Arabia was quietly rewiring its entire financial nervous system toward Beijing. The pivot wasn't announced in press conferences. It was written in trade data, currency swaps, and infrastructure contracts that told a story American officials refused to read. The numbers don't lie, even when diplomats do. China-Saudi bilateral trade hit $87.3 billion in 2021. China now consumes 21.7% of Saudi Arabia's total oil exports. America gets roughly 3%. More critically, Saudi Arabia runs a trade surplus with China of $20 to $40 billion annually, up from $5 to $10 billion a decade earlier. That surplus used to flow to America. It used to recycle into treasuries. Now it accumulates in yuan And the question becomes, what do you do with yuan? The currency infrastructure tells you everything you need to know about where this is heading. October 2023. Saudi Arabia executes its first crude oil purchase in digital yuan. June 2024. The kingdom joins mBridge, the cross-border digital currency payment system that lets central banks settle transactions without touching dollars or SWIFT. 2023. A $7 billion currency swap agreement between the Saudi and Chinese central banks, creating a direct liquidity line that bypasses New York entirely. And in 2018, long before anyone was paying attention, Shanghai launched yuan-denominated oil futures contracts. The rails were being built while everyone argued about whether they'd ever be used. Here's the detail that matters. Yuan use in China's international trade has doubled since 2017, now sitting at 23% of total transactions. That's not global dominance, but it's not irrelevant either. For Saudi Arabia, the question was never whether yuan could replace dollars globally. The question was whether yuan could provide an alternative channel for the specific bilateral relationship that now matters most. And the answer is yes, because China built the spending mechanism that makes it work. When Saudi Arabia sells oil to China for yuan, what do they do with those yuan? You can't buy much outside China with renminbi. The currency isn't freely convertible. Capital controls limit its usefulness. But you can buy Chinese goods, Chinese services, and Chinese infrastructure projects. Vision 2030, that ambitious plan to transform Saudi Arabia's economy, costs hundreds of billions of dollars. Who's building NEOM, that futuristic megacity in the desert? Chinese contractors. Who's constructing the rail networks, the ports, the technology infrastructure? Chinese engineering firms. Who accepts yuan as payment? Chinese state-owned enterprises backed by Chinese state financing. The recycling mechanism that defined the petrodollar that flow from oil sales to Treasury purchases to American deficit financing is being replicated with Chinese characteristics. Petroyuan flows from oil sales to infrastructure contracts to Vision 2030 projects. The system works because China offers what America no longer provides. Insatiable demand for every barrel Saudi Arabia can produce, zero human rights lectures about Jamal Khashoggi or Yemen, and the patient capital to build the diversification projects that Saudi Arabia's survival depends on. But here's the twist that confuses everyone watching this unfold. Even as Saudi Arabia builds this yuan infrastructure, even as the kingdom joins Chinese payment systems and signs currency swaps and executes digital yuan oil transactions, Saudi holdings of US treasuries increased to $144 billion as of October 2024. That's the highest level since 2020. The dollar share of global reserves fell from 70% in 2000 to 57.4% in 2024, a 30-year low. Yet yuan's share of global reserves sits at just 2.1%, stalled since 2022, despite all the infrastructure and all the agreements and all the Belt and Road financing. Saudi Arabia isn't abandoning the dollar, it's creating options. The pivot isn't revolution, it's insurance. And insurance is what you buy when you no longer trust the institution that used to guarantee your security. August 2023. Saudi Arabia receives a formal invitation to join BRICS. Western analysts panic. The headlines write themselves. Saudi Arabia abandons Western alliance. Petrodollar collapse imminent. China wins the Middle East. Then something strange happens. Nothing. January 1st, 2024, the supposed membership date, passes without Saudi confirmation. October 2024, Saudi Arabia sends only its foreign minister to the BRICS summit, not Crown Prince Mohammed bin Salman himself. December 2024, January 2025. Reports emerge that Saudi Arabia has suspended its membership bid entirely. The kingdom is neither in nor out, not committed, not declined, just waiting. And the ambiguity itself is the strategy. This isn't confusion, this is calculation. Saudi Arabia is executing the most sophisticated geopolitical hedge in modern history, and every non-decision is a decision. March 2023. China mediates diplomatic restoration between Saudi Arabia and Iran, ending years of proxy conflicts and sectarian tension. Washington wasn't consulted. It wasn't even in the room. December 2022. Xi Jinping receives a red carpet welcome in Riyadh. 3-day state visit. Comprehensive strategic partnership agreements. Biden had visited months earlier to a fist bump and public humiliation over oil production requests. October 2022, OPEC Plus cuts production by 2 million barrels per day, despite direct pleas from the Biden administration. US-Saudi relations hit what officials called an all-time low. March 2022, Mohammed bin Salman refuses to take Biden's phone calls during the Ukraine crisis, while oil prices spike above $100 per barrel. The pattern is unmistakable. Every time Washington treats Saudi Arabia as a subordinate rather than a partner, every time American officials lecture about democracy while begging for oil production increases, every time the security guarantee feels conditional on Saudi compliance with American domestic political needs, Riyadh takes one step closer to Beijing. But never the final step, never the irreversible commitment. Because Saudi Arabia's balancing act requires keeping both powers invested in the outcome. Look at what the kingdom is actually doing. US relationship, damaged but not severed. Military cooperation continues. Intelligence sharing persists. China relationship, growing but not exclusive. UN infrastructure expands. BRIC status, considering but not committing. The invitation remains open but unaccepted. And those Treasury holdings, increasing, not decreasing. $144 billion, up from $117 billion in June 2023. If Saudi Arabia were truly abandoning the dollar, that number would be falling, not rising. But beneath this diplomatic choreography, there's a crisis that explains everything. Saudi Arabia's fiscal breakeven is $96 per barrel. Current oil prices hover around $70. The 2024 budget is projecting deficits. The current account surplus collapsed from 50% of GDP in 1974 to 0.5% today, heading negative by 2025. Vision 2030 projects require hundreds of billions in spending. The domestic subsidies that buy political legitimacy cost tens of billions annually. The system is bleeding, and the bleeding is accelerating. When your economic model requires oil at $96, but the market delivers $70, you can't afford ideological loyalty to a security guarantor who lectures you about human rights while fracking themselves into energy independence. You need customers who'll pay top dollar. You need financiers who'll fund mega projects without conditions. You need options, plural, because depending on a single protector who stopped needing your product is how empires die. This isn't about ideology or alliances, it's about financial survival. And Saudi Arabia learned the ultimate lesson about American reliability when the Biden administration spent 18 months negotiating a Saudi-Israel normalization deal, offering a NATO-level defense pact and civilian nuclear programs as incentives, only to watch it all collapse after October 7, 2023. Mohammed bin Salman discovered he could extract maximum concessions from Washington's desperation for a foreign policy win, then walk away when the domestic political price became untenable. American promises, he learned, are negotiable. Chinese infrastructure projects are concrete. So what does all of this mean for you? For your savings account, your retirement fund, the dollars in your wallet that you assumed would always be worth something because they've always been worth something? The petrodollar didn't die in a spectacular collapse with sirens and breaking news alerts. It's dying the way these systems always die. Gradually, then suddenly, then gradually again, while politicians pretend the old rules still apply and economists debate whether anything has changed at all. Here's your financial reality. The dollar's share of global reserves dropped 8 percentage points in 10 years, from 66% to 58%. If that pace continues, and there's no reason to think it won't, the dollar falls below 50% of global reserves by 2034. That's not doomsday. That's not collapse. But it's the end of hegemony. It means the United States can't run unlimited deficits without consequences anymore. It means higher borrowing costs. It means when the Fed prints money, the inflation stays home instead of getting exported to the rest of the world. It means imported goods get more expensive as the dollar weakens, and other countries stop automatically absorbing dollars they no longer need for energy purchases. But here's the twist that the alarmists broadcasting dollar death never mention. Saudi Arabia is not dumping dollars. Treasury holdings increased to $144 billion, the highest level since 2020. Why? Because the alternatives are worse. UN sits at 2.1% of global reserves, stalled since 2022, despite all of China's infrastructure spending and all the currency swaps and all the bridge payment systems. The yuan internationalization campaign hit a wall, because reserve currencies require things China won't provide: open capital accounts, rule of law, deep liquid markets where foreigners can actually spend the currency. The BRICS common currency remains a blockchain stage fantasy that 9 member nations with completely different economic interests can't agree on, beyond vague communiques about exploring alternatives. The system isn't collapsing, it's evolving into something Americans aren't used to: a multipolar currency world where the dollar is dominant but not hegemonic. 58% of reserves instead of 70%. The largest currency, but not the only currency that matters. Regional alternatives emerging for bilateral trade: yuan for Asia-Pacific transactions, rupees for India-UAE commerce, local currency swaps proliferating across emerging markets. The US still dominates global banking through SWIFT, derivatives markets, international contracts, and debt issuance. But it's losing ground in reserve percentage, oil trade exclusivity, and the unquestioned assumption that there is no alternative. For you as an investor, diversification stops being theory and becomes reality. 40% of global reserves now sit in non-dollar assets, up from 30% a decade ago. Central banks added 3,626 tons of gold since 2005, with China and Russia leading the buying. For you as a citizen, higher inflation risk becomes permanent as the dollar loses its reserve premium and imported goods cost more. Potential benefits exist too: stronger exports as the dollar weakens, rebalanced trade, possible manufacturing revival. But the transition period is painful. Ask anyone who lived through the 1970s and 80s what it feels like when reserve currency status erodes. For policymakers, if any are listening, stop weaponizing finance. Every sanction, every frozen asset, every time SWIFT gets used as a geopolitical weapon, another country decides that dollar dependence is a vulnerability rather than a convenience, and starts building alternatives. Embrace multipolarity instead of fighting it, because trying to maintain 1974-era hegemony hastens its end. And fix the fiscal disaster. $2 trillion annual deficits work fine when the world has no choice but to buy treasuries. What happens when they do have choices? The Saudi pivot isn't the end of dollar dominance, it's the end of dollar supremacy. America remains the world's largest economy, deepest markets, most liquid currency. But the days of dictating terms, running unlimited deficits, and treating the international monetary system as a geopolitical weapon are ending. The 1974 understanding worked because Saudi Arabia needed US military protection, and America needed Saudi oil. In 2024, America pumps more oil than Saudi Arabia, and Saudi Arabia gets security assurances from Beijing. The economics changed, the leverage shifted, the customer became the competitor, and when Mohammed bin Salman wanted to build his futuristic megacity, he called Chinese contractors, not American ones. That tells you everything you need to know about which way the future is flowing.